All right, everybody. Welcome to another episode of the Everyday Trader. This is Eric Hale from Trader Oasis, and I'm joined by Greg.
Good to be here. Crazy day in the market for sure, but still good to be here.
You know, your thing, as long as I've known you, which is going on closer to 20 years, I think your thing is interesting day in the markets.
I said crazy today. So
You said crazy, but I think your thing has always been that, the key takeaway for me is that you find markets interesting.
oh
That
yeah. Markets are fascinating.
there's almost always something interesting happening every day. And we've had some really interesting things going on this year. And so in this episode of the Everyday Trader, we want to talk more about sort of macro, what's happening in the market data, rather than talking about a specific strategy or something. We got some ideas of some stuff that we wanted to review, but I mean, we're looking at very strong start to the year. So this is the S&P 500 SPY ETF. If we did a little zoom out here, look at what's happening recently. Yesterday was one heck of a day. Really big move up this week. Today we're actually up off our lows today, but in the trend looks like it's still continuing. Mostly that's due to, well, I don't know, was it a good report or a bad report? We had our jobs report that came out today from the FOMC, or I'm sorry, Bureau of Labor Statistics, publishing the lowest unemployment rate that we've had that I can remember since I've been paying attention to it. I mean, I think I was 10 years old when the inflation rate was this, or maybe a little younger than that, was at 3.4%. What was your reaction on the jobs report?
Well, my reaction was a very dismal forecast of my belief in economists. I mean, come on. You missed it that bad. You were expecting 185,000 and it came in at 517. How bad did you miss that forecast? I know it'll probably be revised and people are trying to give the economists some leeway, saying, oh, well, this is the January jobs hoarding that happens sometimes in the holiday season, and they'll all get laid off in this month. And February is the real important report because that's when real hiring. But regardless, I think that's just trying to throw the economists a softball and give them a way out. It was a really strong jobs report, in my opinion.
Oh my gosh, yes. So the non-farm payroll number coming at 517,000 jobs added. It's literally twice the upper bound of the consensus range. The 3.4 to 3.6. We really missed it, and this is just a testament to how powerful the labor economy is. This is going from advisors' perspectives. I think they do a nice job writing things up and looking at it. Looking at the non-farm payrolls, and another chart that I like to look at is from Fred. So here's the 3.4% that we are. I mean, we hit a low of, I think, 3.5 in February, but we got to go all the way back to here. I mean, to
early 70s. Yeah.
Early 70s. So yeah, I was like 6 years old the last time that we had a 3.4. Something doesn't jive, right? Where this is supposed to be a bad market, isn't it? Isn't that what everybody was telling us, that things are supposed to be bad here this year?
Well, yeah, and I think that's maybe one of the narratives that also forecasters have gotten wrong this year. Absolutely. Is that the market was going to start off bad, and we were going to trough at the first half of this year and then rally towards the latter half of the year. We're seeing a really strong job market still. And as you dig into it, I know the question that some people are asking right now with this really big number today is, well, wait a minute, what about all these big tech companies that have been laying people off? I mean, it's been the headline about Amazon and Google and Meta and Apple and PayPal, and you go down all the tech darling names, they're all cutting people off right now. the word on the street though is that those jobs they're able to find a replacement job within a week of being laid off, and it's in small businesses. And there is strength in the economy right now and a demand for employees, and we saw it again this month. And that's not only reflective, I think maybe the other important part of the really hot jobs market isn't just the total number of jobs, but that the average work week also increased pretty significantly, and so people are taking home bigger paychecks as well.
That's important, because the negative side in the report was that labor rate went down, hourly earnings went down, right? So but as our friend Sam Ryan says, consumers don't spend rates, they spend paychecks. And what went up is the average work week, and that's where the news is. And that's a really good leading indicator in terms of labor, is that when the work week starts to go down, because what happens is businesses start cutting hours. They cut back on overtime, and then they start, taking people down from 40 hours a week to 30 hours a week. And so looking at that average work week has always been a leading indicator to get some insight into where labor's heading. It's going up. So even though labor, and that's actually there's some good news in there from what the Fed is trying to accomplish, that if we're seeing that the average labor rate is going, we see wages going down a little bit, but hours going up, people are getting more money in their paychecks. And this is a testament to this resilient consumer that we've seen. You started talking a little bit about the forecast. We had a forecast for what we've been told they're going into the end of the year. We had such a rough year last year, and that was, because due to these global headwinds, that we had falling global growth due to what could be a global recession, and that we were expecting everybody expecting earnings. And we'll talk a little bit about earnings, because we had 3 doozies this week. And maybe this changes things a little bit, because up until yesterday, I felt kind of confident saying that earnings has been much stronger and better than the dismal forecast. And then the third big thing, so we've had, global growth hasn't been as bad. Earnings has been a little bit better. And then the third thing has been that inflation. It's been named the immaculate disinflation. So I don't know who's calling it that, where that term came from. I saw Megan tweeted it out today. Our friend Megan Green, economist Megan Green from Kroll, tweeted out some comment about the immaculate disinflation. We're seeing inflation numbers come down, which is, I don't think the Fed doesn't want to hurt labor. I mean, they don't want to hurt jobs. They'd love to see people keep their jobs and try and keep inflation under control. So seeing wages come down, I think that explains a lot of why the market on this really strong jobs report didn't have more of a negative impact, because there's a mix of good news and bad news. And I think there's a narrative that works.
Well, I've got a different opinion there, but I think, don't get me wrong, I love Megan. She's a brilliant lady. I personally think immaculate disinflation is going to go right up there with transitory. You're here pretty soon. I personally think the bigger risk that this poses for us right now is that what the Fed is trying to do is going to run into this headwinds of this really strong job market. And when people have bigger paychecks to spend, they're going to spend it on things. And we saw that in some of the earnings. To jump to one of the earnings events for this week, we saw that in, just use Starbucks as an example. And Starbucks saw a better than expected earnings report, but it wasn't driven by an increase in demand. It was driven by an increase in pricing. So their margins have gone up, and consumers are eating it right now.
That's an important point. This is an important point, because this is something we're seeing across the board.
Yeah, this Starbucks is just one example, but the companies that have pricing power right now and can raise prices, they're going to show good earnings reports.
Right.
But what that's also going to do is it's going to drive inflation back up again, as long as the consumer has that strong paycheck to keep spending. And so on the surface, it's a good report, and it is. I'd rather have this right now, because this is still a possibility of soft landing. right? If we can have a good, solid jobs and somehow pull inflation down at the same time, that's what the Fed's trying to do with this soft landing. I still think what it's putting back in tail risk right now is this idea that if we get a really acceleration in risk appetite again right now, if the markets take off again right now, we may be back in the same situation in 6 months that we were facing at the beginning of last year, where inflation starts to absolutely ramp up again. And we see oil prices go through the roof and everybody starts chasing risk, and therefore inflation starts to take off again. I hope that's not the case, because then the Fed's going to have to slam on the brake. We'll have a second round of the Fed slamming on the brakes at the end of this year, maybe first part of next year.
I wanted to share that quote that you alluded to on Starbucks. So global comparable store sales increased by 5%, primarily driven by a 7% increase in average ticket, partially offset by a 2% decline in comparable sales. North America, U.S. comparable sales increased 10%, driven by a 9% increase in average ticket and a 1% increase in comparable transactions. So it's pricing power that these companies have, so which does not, this is an inflation problem. The Fed doesn't want to see that happening, but that's how companies have been able to pass this along.
Yeah, and like I say, like you said, it is an inflation problem potentially, but what it also is it's a really good situation for companies that do have that pricing power, because that means they're going to continue to make money, and that's going to drive their share prices higher. So it still could be bullish. Doesn't necessarily mean that this is going to be bad for stocks and stock prices. In fact, I think we're seeing in the price action since the Fed's meeting earlier this week, we're seeing this price action almost, it feels almost like FOMO again the last few days.
It does.
Who cares if Apple missed earnings for the first time in 7 years? The last time they missed an earnings expectation was 2016. And yet the stock went on an absolute tear in anticipation of earnings, and now is up another $5 after the earnings report. Even when Tim Cook came out and said, some pretty pessimistic things about the global economy right now. The market doesn't care. They're buying up Apple like crazy. And I think part of what's going on is we're seeing this short squeeze in the whole market. A lot of the funds that made money last year, big hedge funds, were net short a lot of these big names, and they made good returns this year. And I think they entered into the year thinking the same thing was going to continue in 2023, and that narrative has shifted. And all of a sudden, I think they're starting to chase. I mean, let's be honest. Apple right now has got a trailing PE of 25. And I'm pretty sure after listening to Tim Cook yesterday, he said they don't expect any earnings growth in 2023, like zero, and only like single digits, like 6 or 7% earnings growth in 2024. I mean, a 25 PE on a stock that doesn't expect to grow earnings in the next 2 years seems a bit pricey, doesn't it?
It does. What's somewhat astounding to me too, and I know you read the analyst upgrade report that we put out at Trader Oasis this morning, that the vast majority of analysts post earnings upgraded. It was slightly. I mean, you're seeing like prices from like 150 to 160 or something like that. Not huge increases, but nearly everybody. I did see a couple of downgrades, but they were slight. Overwhelming. The theme was for an upgrade from analysts, which is interesting. I wanted to talk a little bit about this weirdness that happened this week. So this chart, bear with me, it's maybe a little bit hard to see, but the purple range is after hours. So this is Amazon, right? So here's Amazon on the 1st, which is, today's the 3rd. So that was Wednesday. After hours, we see the stock go from 105 up to 109. Huge move after hours, and then pops up. By the way, earnings was here. So earnings was 24 hours later. which this happened almost all exclusively. Well, what was the reason for Amazon popping after hours? What do you think? I know you know. Do you know?
I don't know.
I mean, Meta was up, but I think there's something bigger going on in the market here, that's maybe causing this. That
I mean, I have a theory that we're starting to see, and I don't know if you want to call it speculation, or if you want to call it manipulation, but we are seeing massive spikes in volume of 0 day till expiration options. And is that what drives these stocks sometimes intradays? It could be. I can't say I know, Eric, but
well,
it's in the back of my mind thinking that that's impacting prices right now.
I know you, by the way, so those of you that aren't following me on Twitter, follow me with a grain of salt. You got to take things with a limit. But I did put this out yesterday, so that the largest volume session of all time, 68 million contracts traded over the course of the session, with another record in all-time calls, 40 million calls traded over here. So total volume of options hitting an all-time high. Look at the trends. This is going back, what is that? So from 2000, just this shift that happened. We had this epic shift that happened during COVID, and we're seeing there's multiple things that are going on in here. This isn't all retail traders. Greg's talking about this 0 day option trading, which is certainly one of the shiny things that has gotten retail traders looking at it. Oh, by the way, if you want to follow me on Twitter, Eric714, and Greg, you're
Options Animal 34.
Options Animal 34. Okay. So yeah, I would encourage you to take a look at some of the stuff we put out is pretty good. Sometimes there's other noise about other things, like here's me getting my blue belt. This was yesterday. So anyway, so you'll get a mix of personal stuff, and I think some good market stuff as well, if you're on Twitter. I know social media's got its issues here, but we were talking about the 0 day to expiration thing, which is, I mean, we're talking on a daily basis, index options trading around 8 million contracts a day. And it has certainly picked up the attention of retail traders. And there's the gamma theta crowd, which is a euphemism for the social media horde that probably had something to do, and no question they had something to do with the meme stocks that we've seen over the past couple years, the GameStops and the Bed Bath and Beyond and AMCs, that a horde of people decided they were going to go out and try and take advantage of some idiosyncrasies in the market by trying to buy short-term options to cause price spikes. And there's some debate whether or not that was going on. Were they? I think there's a lot of people who made money. I'm sure there's a lot of people who didn't make money as well. But this is something different going on. I think there was definitely something that was initiated by retail traders, and then institutions definitely dumped in, because if you go look at the volume of all of those meme stocks, you can see where the institutions jumped in and started taking advantage of it. I don't know if that's a way to make money or not. I think it's interesting to keep an eye on it. Sparkly, shiny things always get my attention. It's like a car accident or the Kardashians. I can't help but look. I don't know that I want to get involved in it, but I look. And the 0 day to expiration thing has been huge and definitely gotten a lot of attention. But we have some insight into what's causing that. Do you have any thoughts on that before I dive a little deeper there?
Well, I think, and maybe I'm going to, leg into some of your thoughts here as well. I think one of the things that's causing this is actually a testament to the validity and the stability of the options market. In the past, a market maker who's making a market, whether it's in a big index like the S&P 500 or whether it's in individual stocks, oftentimes what they do when they sell a position is they'll take the opposite trade. They don't like to have risk. Most market makers don't. And in the past, they've always used futures. because that was what was available. The options market was very thin. It wasn't really available other than maybe doing it with the SPY a little bit as the SPY started to get traction. But I think over the last 4 to 5 years, especially as we've seen more volume introduced into the options market, and a lot of now, I would also say the computerization, the automation of the trading in the options pits. You know, when I first trade, I remember first going on a tour of the CBOE back when everyone was still trading and everyone was sitting around a computer screen, and you had traders who were executing trades and walking around with order books and, you know, filling people's trades. And you had the IBM pit, and you had the Apple pit, and you had the Microsoft pit, and you had the General Electric pit, and, you know, everybody was bouncing around. Now it's like 5 or 6 guys making sure the computers are still running.
Yeah, they're there to yank the computers. The pits are filled with computers and guys who can unplug them if they.
Yeah, exactly. And so I think it's actually a testament.
I want to pause and back up, and you went over something really fast there, and I think it's important for people to understand how an options market works. So you buy options, and let's say, for example, you buy a call. So a call is something that has a very limited risk. We talked about calls in our last video, which I encourage people to go back and check out. There's some important concepts. I think if you're buying options, selling options, you should review that. Some good stuff. We got some good feedback from that. But if you buy a call, the person who sold it to you has a short call, and that is a trade that has a high probability of a small profit, but it also has infinite loss potential in a very bullish move. And we're seeing the sort of moves that are happening in this market, especially, but in any market, boring or exciting, market makers do not take risk. They make money off of the bid-ask spread and prefer to be what's known as delta neutral. And so when you buy a call, the delta tells you how that call price changes when the stock price changes. And typical at the money call is 0.5 delta. So if the stock goes up by $1, the price of the call goes up by 50 cents. That's what 0.5 delta is. Whoever sells that to you has the opposite delta. So they have a negative 0.5 delta. And what they can simply do is go buy 50 shares of stock. And that gives them a delta neutral theta positive trade. And that trade will make money as long as the stock is stagnant. But if the stock starts going higher, they're going to have to buy more shares. So that's when the market was a lot more simple, and that there was market or specialists or institutional market makers who are trading in one market, and they're only trading Apple. So they're only trading Apple. And there's a lot of that going on right now too, because we're seeing the short-term Apple options change as well too. But for somebody who's a market maker who's selling a swath of equities, it's easier for them to, and this is where things get a little bit funky, they beta weight their portfolio to which is a correlation of volatility to an index. And it could either be the SPY or it could be the NASDAQ. And right now it's happening, or SPY, I mean the S&P 500. So instead of buying Apple stock, because I'm selling options, I'm a market maker, I'm selling calls in Apple, I'm selling puts in Microsoft, I'm selling Bank of America. So you name the swath, which looks a lot like the S&P 500 or a good portion of it, probably the top 20 stocks. I can just buy futures instead of going out and buying those individual equities. I can buy futures to make my overall portfolio delta neutral. And market makers do that. That's how they normally trade, is they're taking they're providing whatever people want to buy, calls, puts, whatever, and they're just trying to keep their portfolio. It's a risk management thing. Now, they buy those they buy those futures on margin. So here's where the zero DTE thing is starting to emerge. A couple things have happened recently that haven't been in place for a decade. So first of all, there are options that expire every other day. So there are S&P 500 options that exist, and the liquidity has become great. So there's really good availability of them. The other thing that's changed is interest rates have gone up. So market makers, this is the reason why the risk-free interest rate works its way into the price of options. As I mentioned, when you buy a call, somebody else sold you the call, but they had to buy stock, and they bought stock on margin. And that margin gets put into the price of the call. That's why we have row. That's why the risk-free interest rate factors into the price of options. It's because the market maker is, if the interest rate goes up, they pay more money. So there's a wonky thing that's going on right now. And that is that, so the primary book is who they're borrowing money from. So they, Virtue or Citadel or some other places providing margin to the market maker. And they require that they have certain risk management policies in place. There's an interesting sort of loophole, and there's nothing nefarious going on. But if you have an option that expires in the same day, you don't have to pay margin on it. And with interest rates going up, there's a point that it makes sense for a market maker. Now follow me on this. Instead of going out and buying futures and paying margin on the futures, I can buy a 0 day till expiration option and not pay margin on it. I still have to worry about my risk management and everything, but I don't have to report it to my primary book. I know this sounds really wonky, but it's the market makers, and there's nothing nefarious about this at all. There's nothing that's, somebody's trying to pull something over somebody's wool. It's all open light. Everybody knows about it, at least in that business. It's not something that maybe everyday retail traders are aware of, but we've certainly seen the volume going up in these options. And this is why. And retail traders are trying to jump on, not that there isn't a strategy that could work, that people can see this volume going up, because the increased volume means great liquidity. And so I think that transaction costs become low. I think there's something there, but this is different. My point is, this is different than the meme stock thing. The meme stock thing was retail trader horde going out, causing market makers to respond. What is happening right now is market makers just finding a more efficient way to manage their capital and manage their risk using 0 day. It's not being caused by retail traders.
Yep, I agree with that. Now, that doesn't mean that there still isn't some ways to manipulate it, especially on an individual stock. And like I was saying 10 years ago, you couldn't have done this because there wasn't daily options. There wasn't the volume in the options. Right. There wasn't the low transaction costs. All of these things that we've seen the options market get more efficient in have allowed for this form of hedging, is basically what you're explaining right here to people. And so I know that was you should go back and re-listen to what Eric just taught you, by the way, because that's exactly what's going on in 0 day till expiration options. And there's not a lot of people talking about it, other than sometimes on the mainstream media, you'll hear, hey, there's this big spike in daily options. It must mean the market's speculating. No, not necessarily. No, it's just a function of the markets.
Yeah, this chart that I shared here is, I love it as an option trader, even as a retail option trader. Liquidity is one of the biggest things that we need in order to be able to make money. We have to have tight bid-ask spreads, and I've seen bid-ask spreads. I've lost 30% in a trade because the liquidity is terrible, and we have to be careful, because when things get rocky, liquidity goes away. This is one of the liquidity is how easy it is to trade things. And when we've got 70 million or 68 million contracts traded in a day, liquidity gets really good. So I'm okay with this, but we do. I just think that retail traders need to be really careful in what they're doing here. What we're seeing is some of the trades that I've seen retail traders try to do in the 0 day is doing way out of the money credit spreads. So selling a call and buying a call way out of the money, or selling a put and buying a put way out of the money. These trades have very, very high probability of working. I mean, we're talking like 80, 90%, but you're bringing in $200 maybe and risking 1,800 or maybe 2,500 or something more than that. And just because you haven't experienced that loss yet doesn't mean you're not gonna. You got to be really careful with these credit spreads, because when we see some weird things like this happen in the market, sometimes it breaks things. And there are a lot of people who are concerned about something in the market breaking. Did you read the Universa hedge fund letter this month? I posted it yesterday for options.
I did. Yeah, I did.
Let me pull that line. I got to pull up this line. So this is, by the way, or do you want to move on to something else?
No, I was going to say, while you're pulling it up, I just wanted to share bid-ask spread. It reminded me of when things get crazy, that your bid ask spreads can go wide. I actually took a snapshot on what was the day? Who's the hedge fund guy that came in, was crying on CNBC during COVID? This is the end of the markets. Not Einhorn. He's the guy that got in a big argument on CNBC once. Anyway, his name will come to me eventually. It was the day that he came out and was crying. Anyway, the
Jim
SPY,
Cramer?
I took a
No,
bid.
Jim Cramer? Was it Jim Cramer?
It wasn't Jim Cramer. I took a snapshot of an option that was right at the money on the SPY, and it's bid $12.57. Last trade was $23 was the price last trade. Bid $12.57, asked $32.49. Just crazy bid. And that was, just a couple years ago. So yes, remember that when things get crazy, we want that liquidity because it helps narrow those bid-ask spreads.
And here's the thing about it. Murphy's Law is going to tell you the liquidity might be iffy or okay getting into a trade. When it's going to be really bad is when you want to get out. That's when it happens, right?
Exactly.
It's when you want to close a trade that the liquidity gets crappy. But, not to throw a wet towel on this discussion, because I am still pretty bullish, but this Universa Investments, which is Nassim Taleb and Mark Spitznagel, and these guys got a lot of attention through the COVID crisis, that the Universa Investments portfolio was up something like 4,000% during COVID. And they had a good year last year. I think they were up 100% last year, if I'm not mistaken. But the closing sort of paragraph here, the leaving with this message, but we're living in a mega tinderbox time bomb. It's objectively the greatest tinderbox time bomb in financial history, greater than the late 1920s, and likely with similar market consequences. Now, as then, it's our own making, and it defines our very age of existing in this age of economic interventionism and hubris. So these guys are free market capitalists. They're not very happy. There's some stuff in here about Mises, and I love any quotes from Seneca. Little philosophical newsletter if you get a chance to read this. But there's some reason to be cautioned out there. And people going unhedged without any sort of risk mitigation or using stop losses or something else. I think did I show that? Was that on the screen? I did share that, right?
No, it wasn't. It's just you and I have been talking. It was Bill Ackman.
Oh yeah. Ackman. There we go.
That's who was crying on CNBC.
Yeah. So there's the quote. So we're living in a mega tinderbox time bomb. It's objectively the greatest tinderbox time bomb in financial history since late 20s, which is quite a statement.
So yeah, I read that yesterday on Twitter, or maybe it was this morning. Someone had attributed it to Nassim Taleb, and it actually wasn't. But then Taleb said that wasn't me; it was Spitznagel.
Right.
But it's not that I disagree with him. It's basically what Taleb said.
Well, they're partners. Spitznagel and Taleb are the blacks. Anybody's read The Black Swan or Fooled by Randomness, Skin in the Game, which are all great books, which I think everybody should read. Taleb he's a character, but he's really freaking smart, and he's got some great points, and I definitely would not want to get in an argument with him. But his edge has been in recognizing that the models which we base option pricing on are inherently wrong. We use this normal distribution, which is built into option pricing models. We know it's not right. I mean, it's right maybe 95% of the time, but it's that 5% of the time. If you let me show you the logo that they have for the Universa letter is it's this thing right here. So we've got a normal distribution and then a long line that goes out here. This isn't an accident. This just isn't so most of the time we expect movements to occur in here. Oh, let me break out my quincunx. So this is a tool that they use to teach people how to understand how stock markets work. And we're looking at a normal distribution here. And the idea is that the stock moves, whichever, am I doing this the right way, the wrong way, that the stock is going to go, where's the stock going to be in 2 weeks? You know, is it going to be way out here? Is it going to be in the middle? And most of the time we're going to be in here. We use the standard deviations to talk about that. What Universal Investments is saying is that if you've got this, you could have a BB out here. Like, that's not in the pricing model. So the models that we use assume that everything sort of stays within the bounds of what we see here. The reality is, and we have seen movements that come way out here. And those are not necessarily, they're not to be confused with a black swan. A black swan is something we haven't thought of yet, haven't imagined that could happen. They cause big statistical movements. And we've seen plenty of big statistical movements in the past. We should expect that they're going to happen again. I don't know where I lie in terms of hedging it, but Spitznagel and Taleb, they're pretty smart people. So I'm not bearish, but I do think the message is don't go unhedged. Always make sure that you have, some sort of protection and plan, whether it's collar trades or getting yourself stop loss orders or something.
I think that's a really important point, and maybe we can wrap up on it. But as you're trading, there's a lot of different tools, and you can get opinionated one way or the other, and your trades can reflect the opinion, but don't be so prideful or dogmatic in your analysis that you go without proper risk management. That's really, in my opinion, the only way you trade long term. Otherwise, you may have a great couple of years and then you blow your account up because of that, 5 standard deviation move that wasn't supposed to happen, and your trading model was built around it not happening, and it blew you up. And so just make sure that as you approach the market, that you understand risk, that you understand your cost and your exposure in every single trade you do, because otherwise you can wipe out years of gains, if not your whole portfolio, with one mistake.
Yeah, I think that's a great point to wrap it up. The other thing I would tack on is that if you recognize that you can use option strategies to make money in any direction, they can make it. And if you can develop plans that allow you to be nimble enough to adjust, your mind shift changes from being right about the direction of the stock, which is really most people are not good at it, to making money. And it minimizes the emotion. It's what's allowed me to be successful over the long term here, is just getting rid of that emotion about being vested in my belief in which way the stock is going to go. I just need to know when to make an adjustment, when to fix myself. I don't know if you saw my Amazon trade this week. I placed a bearish Amazon trade, and Amazon's spiked up, and it's dropped down quite a bit, but it's still well above. I placed a bearish trade. So if I didn't make an adjustment, I'd be losing money. But right now, I'm in about a 90% chance of making money in this bullish adjustment. And there was no emotion whatsoever. Crossed a specific place, I follow the adjustment, and boom, I'm going to make money. Could I make more money? Yes. I'm not going to let that get in the way, but don't let greed and fear get in your way. They cloud your judgment, and that's when we make mistakes.
Sounds good.
This is a fun one. I hope people got something out of us.
Yeah, hopefully you listened all the way to the end. If you want more content like this, please let us know in the comments below. Like, subscribe to get more notifications. Click that little bell so you get notifications when we post new stuff. So
yeah, what do you want to hear more of? Thanks, Greg. I agree with everything you said there. So what would help you? What burning questions do you have? How can we help you through what we do here? Everybody have a good weekend. We'll see y'all next week.
See you.